All right. Hey, how you doing, everybody? Bruce here, Stock Markets with Bruce. Welcome to my live show here today. Today is December the 15th. It's Tuesday, and I'm coming to you from Creston, British Columbia, Canada, 3 miles north of the U.S. border, just north of Idaho. Following the markets today and what's going on, thought I would throw in my 2 bits of commentary as to what I think is happening and how it's affecting us and what the future of the markets are going to do. A lot of people are wondering, is this a good time to get in or get out of the market, stay on the sidelines? What's the deal here? And well, lots to talk about, lots to think about, lots happening out there. The markets, have been pretty well at record highs now for the last several months. They've been kind of close and setting new highs and then hanging around. There hasn't been a big sell-off yet from these highs. And the question on everyone's mind is, in the back of their minds at the very least, is there going to be a market correction? Is there going to be a pullback? And if so, what's going to cause it? Because the reason for a lot of people to be exuberant and have jumping all over this market is because of the amount of liquidity that's available and the so-called good news that's coming out there from out there. All the new good news about the virus, the good news about the vaccines, the good news about the improving economy, and things might get back to normal again. And so you had this sort of a back and forth tug of war between stocks that have been benefiting from the lockdowns, the shutdowns, so-called stay-at-home stocks. And now you have this other side, folks who are buying into airlines and buying into cruise lines, buying into hotels, because we might get out of the house and start traveling again. Well, you can't have both. You either have the pandemic lockdown or you have the post-pandemic recovery. And when is this market going to make the shift, and how is it going to make the shift? And are there going to be winners and losers in the market? And if so, with this turnover expected, will this cause the indices to drop, which means index funds will drop in value, or will it make the markets go higher because the shares that are going higher will offset the ones that are going lower, even though they impact the indexes negatively? The other shares impact the indices positively, and one outdoes the other, and the market keeps going. This is this age-old what to do, when to do, how to do, and that's why there's a stock market. It lets you decide for yourself what you want to do with your money, whether you want to gamble and stay in the market, whether you want to gamble and get into the market, or whether you want to gamble and not be in the market. Because sitting on cash sometimes is the wrong move, sometimes it's the right move, and one has to decide, what do I do, which way do I go, and why, and what's the reasoning. If you're a day trader, you don't care. If you like playing the stock market with Robinhood or Fidelity or Schwab and fractional shares, and you're in and out 5 times a day, you don't care. You're just looking for a flip. I want to get in at one price and get out at a higher price and call it a good day today. And if I can do that several times in a day, yeah, this is good stuff. There are companies out there with let's say 100 million free trading shares, but they trade 200 million shares a day. That's impossible. How can that be? How can you have 200 million shares trading hands? There's only 100 million in existence. Well, it's because they're just being flipped over. People are getting in, out, in, out, in, out, in. They're buying, selling the same stock all day long. They might have a stable of 3, 4, 5 companies that they like, and they just follow 4 or 5 stocks, and that's all they buy and sell all the time. They're in and out of these shares. At the end of the day, they do the math if they ever care to, and they realize, oh wow, I bought $5,000 worth of stock today, and I sold $5,100 worth of stock today. I made $100. Do you care that you bought and sold the same stock 10 times over? No. Does it make a difference to the company itself? No. Does it make a difference to the economy as a whole? No, not really. Although you, in your own little way, flipping 500 at a time, $1,000 at a time, whatever you're doing, you're adding to the business. You're adding to the brokerage business. You're making the bankers richer. You're making the brokerage firms richer. The exchanges are getting richer because the activity of stock is good for certain sectors of the investment business. But did you make the company any more richer by buying and selling its shares 5 times today? No. If you're flipping Apple stock, Apple couldn't care less whether you flip the stock or not on an ongoing basis because it's free trading stock. Do what you want with it. Same with options. If you're buying and selling options, you're not affecting the company's operations in any way, shape, or form. No one's getting laid off or hired because of your activities, and the millions of others around you doing the same thing. You're just participating in an instrument to buy and sell against the prospect of the share's value at any given moment. And in some cases, there are folks out there who have a 5-minute attention span for stocks. They get in to get out within 5 minutes. Others want out in 10 minutes, an hour, the day, a week. It all depends on your timeline and what kind of a return you're looking for from your investment cash. So lots to think about, lots to wonder about. In the Dow world, the Dow is flirting around the 30,000 mark right now. Everyone got all excited about it about a month ago, or roughly or so. I remember when it broke 20,000. I remember when it broke 10,000, and I remember when it broke 1,000 because I was a stockbroker when the Dow broke 1,000 back in the 80s, and I believe it was Reagan. Reagan was in the office at the time. And a lot of analysts out there, a lot of, I would say a lot of people who are covering the story, all right? Those who were covering the business story when the Dow hit 1,000, a lot of people came in to cover that story who had no idea how the market worked. Yet they were deemed to be wise enough and smart enough to cover the story for their newspaper, magazine, radio station, television station back in the 80s. And a lot of these folks, we're talking about, oh my gosh, the markets are at unbelievable highs. They can't possibly sustain this kind of valuation. And sooner or later, this will all blow up. And they all thought it was 1929 all over again, even though the market had been at 800 for a long time. And it got to the 900 range. It finally got to 1,000. Inflation alone makes markets go up in value. Just inflation alone makes markets go up in value. But I remember when the markets hit 1,000. I also remember in 1987 when I was a broker, when the markets dropped 22% in one day. And that was the single largest drop that Dow Jones has ever had in any one day ever. And today, if the Dow dropped 1,000 points today, or 1,500 points or 2,000 points, all the networks would cover it like it's the end of the world. But when you think about a 30,000 Dow dropping 1,000 points, that's 3.3% drop. I mean, it's nothing. 22% drop in the Dow today at 30,000 index. You're talking a 6,600 point drop in one day. Now that would equal 1987's volatility. And back in 87, of course, we used telephones to make our trades. We used to hand walk as brokers. We used to hand walk our tickets to our desk traders, who would then pick up the phone and call the floor on a direct line and talk to a fellow on the telephone there who was working with the floor trader and would verbally give him a command to buy or sell. That guy would then either hand signal or yell or hand him a piece of paper to give him the order, and the floor trader would execute the trade with another floor trader or a group of floor traders, depending on the size of the order. If it was a big buy order or a big sell order, you probably had to deal with several floor traders to get what we call get the fill. And then the phone would be picked up on the floor back to the desk trader at the brokerage office, and the desk trader would then get his report. The desk trader would then pass that report to the broker. The broker then would call the client, and the customer who was at the office or wherever they were, who placed the order 15 minutes ago or 20 minutes ago, are now getting a report going, you bought or you sold, whatever you wanted to buy or sell. And here are the results of the trade. That is how it used to be. And in those days, that meant that there were physically only so many trades you could do in a day. Because if it took that long for a trade to be executed from beginning to end, sure, floor traders were fast. Phone guys were quick. The guys were picking up the phone. Desk traders were quick. Brokers were quick. But even so, to be able to buy and sell a stock on the exchange back in 87, it's a 3 to 5 minute process. And so a broker, if he did 4 trades in an hour for his customers, that was a lot of work. If you could do he did 6. It was harried times because you had to call the customer to tell them what was going on, explain to them what was doing, and then you as a broker were recommending to either buy or sell whatever stock, and then the customer had to think about it, and they had to look at the portfolio, and maybe I have to sell something to buy something, or I have to buy something to sell something. On and on we go, and then the tickets got written up by hand, and then the broker would hand it in. But if the order was over a certain size limit, it had to be initialed by the branch manager before it could go in. Maybe an assistant manager or maybe the credit officer of the firm had to initial certain size orders before they could go in, or certain accounts were under restriction because they had been panking, buying and selling without paying for stock. And so they were on trading restrictions and all kinds of crap like that. And so there were all kinds of logistical delays between the thinking of putting in an order, getting an order executed, and getting back to the customer. And by the time the customer got the report saying, hey, yeah, you bought 1,000 shares or 10,000 shares at $2 a share, $18 a share, whatever you bought, the stock might be 25 cents different in price by the time you got your fill. It's moved. It was a mover when you got in and it kept going, or you got into a hot market and by the time you got filled, it was already backing off, or it was falling and you got out and it kept falling, or it was falling and you got out and then it reversed and went back up again and you were caught at the near the low of the day. I mean, without split second timing, you couldn't have the volumes you have today. You couldn't have the precision you have today. And you were just hoping against hope that you were right. I tell you, there were many a screaming match between stockbrokers and desk traders, and stockbrokers and customers, because customers would feel like they got shortchanged, or they were overcharged, or they got too little for their proceeds. And then there were brokers who were passing that on to their desk traders, and there were desk traders just going, "Shut up! You don't know what you're talking about." A lot of blue, colorful language was utilized in the 80s on a person-to-person basis, where today you do it all on your telephone. You just sit there wherever you are and you play the market on your phone. It's as easy as making a sports bet. That's how easy the market is today for a lot of traders out there. It's as easy as making a sports bet, buying and selling, making a bet on a football game or a hockey game or whatever you want. You can literally use as little money as a sports bet to play the market today as well. And that's the other kooky thing about the markets. When I was a broker back in 1987, and before I started brokeraging in 79, I remember I was a branch manager by 87, but in 79, 80, 81, I remember opening accounts for customers, and the minimum deposit that a customer had to make was a $1,000 cash deposit. That you had to have $1,000 with the firm before you could open an account, because that showed you were serious. You put up some serious cash, because in 1979 I was paying $300 a month for a 2-bedroom apartment. So 3 months rent you had to put down in order. So today, if you live in New York City and you're paying $3,000 a month in rent, let's suppose, because rents have been dropping in New York, let's say you're paying $3,000 a month rent in New York, you need $9,000 to open up an account. Well, there's a lot of brokerage firms that have a $10,000 minimum, and that's par for the course. However, at Robinhood or at Fidelity or Schwab, partial fractional share ownership, it doesn't matter how much you have. They're talking about $50. Send us $50 to set up your account in 2020, and you can buy fractional shares all you want. In some cases, it's a minimum $5 purchase per stock. But I think Robinhood, I think it's $1 or more. You can buy stock. You want to buy $1 worth of Amazon, we'll sell it to you. Unbelievable. Now, you want to make 10 times your money? Not going to happen if you buy $1 worth of Amazon, because Amazon is at $3,000 a share or $4,000 a share. It's got to go to $40,000 a share for you to make 10 times your money. Not going to make 10 times your money buying fractional shares of companies. But you're in the game. And if you've got $1,000 and you buy $1,000 worth of Apple this morning and it went up 4% during the day, which it's doing today, you made $40. If you could make $40 a day, 5 days a week, you're making $200 a week, $800 a month. Hey, it's a gig. It's a nice little side gig, isn't it? Can you be right every time? No. Can you be wrong some of the time? Yes. Can you be wrong more than you're right? Yes. Can you be right 9 times, be wrong once, and make money? No. You can be right 9 times, lose once, and lose it all. This market is unforgiving and is volatile. and you just never know that the trade you make could be the last trade you're going to make for a while, a good trade or a bad trade, or a no gainer, no loser trade. Welcome to the modern day markets. But again, back in 79, 80, 81, in those days, there was no such thing as $1,000 stocks. There really wasn't. IBM was $20, $30, $40, $50 stock. GM was $18, $20. I remember being a broker in a brokerage firm, and it was a quiet day. And it's a branch office. I was in a branch office, and at the back of the room, our floor was like a classroom. We had desks that all faced forward, and at the front of the desk, high up, about 8 feet off the ground, were the desk traders. And you would just walk a ticket up and give it to them, and then they would phone it in, and then they'd put a confirmation piece of paper in a little round hole that had your name on it, and you could go up and get your confirmation, and you could see what you got. One day it was about 11 in the morning, and the phones weren't ringing. It was a quiet day, and the owner of this franchise, of this particular branch, he wanted to kind of get things going, and he wanted to get his 45 brokers buzzing. He wanted to get us talking. Well, what can you do to get us talking? So he yells out from his desk to the floor trader, to the desk trader, just yells out without even writing a ticket. He just yells out, "Buy 1,000 shares of General Motors at the market." The whole office just went, we couldn't believe it. 1,000 shares. It was, I think, if I recall, I think it was a $45 stock or something like that. This was a $45,000 buy order when you could buy a house for $120,000. Buy 1,000 GM at the market. We watched the desk trader pick up the phone, call the direct line to I think in this case, she had to contact Toronto, give Toronto the order. Toronto had to pick up the phone and call New York to the floor trader, who had a phone handler. The phone guy got the order and gave the signal to the GM trader. The GM trader bought the stock, got the signal back, called Toronto. Toronto called Calgary, where we were, and the desk trader yelled out, "You bought 1,000 at 45 1/8." And the office just went abuzz. $45,125 had just been bought. US. This is American money. We're in Canada. This is like 55,000 Canadian dollars. We were speechless. And then when we started, then we all on our computers, all of us had these desk trading terminals. We all punched in GM. What's the stock doing? We're watching it. This guy bought 1,000 shares in his personal account. The owner of the brokerage firm bought 1,000 shares in his personal account. And an hour later, he sold them for 48 3/8. He made a quarter. It was a 25-cent gain. The stock had gone up a quarter. He yells out, "Sell 1,000 at 48 3/8. And 2 minutes later, a minute later, the yelling came back, "You're out at 48 3/8. So we're all going, all right, the boss made $250 in profit. And because he's the owner of the firm, he pays no commissions because he's the owner of the company. He's the owner of our little branch. And so we're all buzzing that the boss made $250. And he yells out, he says, "Drinks on me after the close at so-and-so's bar." He had $250 to take us out for drinks. And that got the office buzzing. And that was the way it was in 1983, 84, 85. Any order like that would just shake up the house because we, as hardworking stockbrokers, were calling our customers and we were working our butts off to get $2,000 to $5,000 trades together to buy and sell stock back in those days. That's how it was, and that's why when the Dow hit 1,000 and the market was valued at $60 billion or whatever the market cap of the whole market was back then, we were amazed, and all of our clients were amazed, and all the public who were being brought up to speed by all these reporters who had no business covering business stories. They didn't know what they're talking about. They were just interested in the big number, all those zeros behind the 1,000 Dow. Today it's at 30,000. And we think nothing of it. It's just, it's a Dow 30,000. We buy and sell stock using this little thing right here. This is all we need now. And we can trade with $50. Unbelievable. But the thing is, there are hundreds of millions of people doing it with a $50 account or 100 or 500 or 1,000. The thing about the stock market is it's kind of gone democratic. It's kind of gone global. And there are people in India, Pakistan, Bangladesh, Ethiopia, Egypt, Israel, Greece, Turkey, maybe not China, but Taiwan, Japan, South Korea, Australia, New Zealand, all of Europe, all of Africa, South America, all over North America, and the USA, buying and selling stock every day, in and out, in and out, in and out. And it has become a day trader's paradise in the last couple of years. And with the pandemic, it's a forced day trading in-house business. People are now buying and selling stock without even talking to a broker, because you can't talk to a broker. There is no way a broker can help you do what you want to do on the market now. The kind of speed you want for a fill to buy or sell, no broker can be your middleman. It'll slow you up. You're out of business. There are people out there who will buy 1,000 shares of Apple at whatever price, and it goes up 30 cents a share. They sell it, and they're happy to score a $300 trade. No commissions in, no commissions out. They net out $300. What they don't know is that they're part of a buy order and part of a sell order that had to be completed in order for them to get in and out. But computers, supercomputers, are handling all these trades and are matching up zillions of orders coming in every nanosecond during market hours to put together board lots of stock to trade stock in and out. The brokerage firms are taking a spread, hundreds of pennies a share, for their profit to accommodate you for no commissions. Well, what do you care? You don't care. You're making 30 cents on a 1,000 share flip, and you're doing it in a 15 minutes, 2 minutes, an hour. Do you care? No, you don't. You're going to complain about, I could have made $1.70 more had I been given the market price at the time I entered it. How can you prove that? How can you prove what the shares are trading at the microsecond you entered your order? You don't care. You're just playing the game. There are folks out there buying and selling 10,000 shares at a time on margin with credit of a penny stock on, whether it's listed on an exchange or whether they're playing, Ford at $7 a share or whatever the stocks are trading at. I don't quote me on these prices because I'm just throwing out some example. But I can see people buying 10,000 shares at $14 and selling them at $14.10. Because 10 cents a share on 10,000 shares, $1,000. Hey, what's wrong with that? You do that once a day, 20 days a month, you got a $20,000 a month business in your hands if you're right every time. And then, of course, there are strategies like crazy where people are buying stock, putting in stop loss orders to protect their downside, and putting in market sell orders, limit up orders to get out. So they're getting in at 44 to get out at 44.10. But they'll also get out at 43.95 if they're wrong. So if they get in at 44 and they've got a sell order at 43.95 in case they're mistaken of the direction of the market, but they've got a sell order already placed at 44.10. The stock, they get in, it goes down 7 cents, they get sold out, it goes back, you've lost a nickel. They get in again and they do the same parameters, and they more time often than not, they're trying to catch a market movement. If the Dow is rising and rising during the morning, they're trying to get into a rising market, get in to get out, get in to get out. Whether they're trading ETFs, whether they're trading individual stocks, whether they're trading currencies, whether they're trading contracts and options, it's just an in and out game. And no one cares about the fundamentals of the stock that they're playing. Because the thinking is, I'm not going to hold the stock. At the end of the day, I'm flat. If I'm the right kind of day trader, I don't own stock overnight. I only have cash at the end of the day until the next morning. And whatever the market wants to open up at, I'll play from there. If you can play that game, you never get caught in the overnight surprise situation where you had stock at 44 and it opened at 42. And oh my God, I'm down $2. I didn't do anything. I just slept and got up and it's at 42. But if you're cash at the end of the night, you're protected. But a lot of folks don't play that way. They think they can read the opening and they try to trade at the end of the day for the next opening trade to get out with a gain, hoping that they're right. But the world doesn't work like that. Sometimes there are nasty little surprises. Anyway, these are just some thoughts of an old guy who used to be a stockbroker who's seen it all. I've seen the change from the paper and pen days to now the computer and the mobile days, and even the verbal days, using Alexa to buy and sell. I wanted to talk today about a couple specific stocks, just to kind of throw a few things out at you, and talk about the IPO market as well in general. A couple things I love. I have another channel on YouTube called Traveling with Bruce. Here it is right here. I love covering the cruise ship market, the traveling business, and I watch the cruise ship stocks very closely. The big three, that would be Carnival, Royal Caribbean, and Norwegian. Well, those three shares have had quite a year. They all started off up here doing really well. Then in March, they all stopped sailing with passengers and their shares cratered. Then they had a summer rally, a little dip, and then in the fall, they had another rally. And right up until last week, Royal Caribbean shares, which had been at 132, down to the 20s, up to the mid 80s, 85, today around 75. Was at 85 just last week. And as the shares were rising through the summertime, the stock analysts out there were upping their targets for all the cruise lines, even though no one was sailing with a paying passenger. There hasn't been a paying passenger on a cruise ship since March of 2020. There will not be a paying passenger on a cruise ship, in my opinion, until next summer. But the cruise lines will tell you differently if you listen to what they're saying. I don't think there'll be any paying passengers with any seriousness until next summer. Even then, I might be early. It could be next winter. Anyway, the analysts were upping the price targets of the shares because the shares are going up, not because the fundamentals of the company was getting better. No, the analysts were going, well, we gave Royal Caribbean a $40 target when it was 25. Well, it's now trading at 50. We got to give it a $60 target. And it went to 60, 65. Oh, well, we'll give a $70 target. The analysts were following the stock instead of them leading the market. They were behind the market. And day traders were going, hey, I don't care if Royal Caribbean doesn't have a paying passenger. If I can buy the stock at 60, and at the end of the week, I can get out 62 or 65, or at the end of the day, or in an hour, I can make a buck or two, I'm going to flip it. And I'm going to flip it in and out, in and out. I'm going to try to catch the little waves here and play this little game as long as this game gives me this game to play. I'm a happy guy. I don't have a job right now. I'm at home, or I'm working from home, but I don't commute to the office an hour and a half in every morning, an hour and a half home every night. So I can get my work done in a 5-hour window here at home, and I do my work before the market opens, and then during the market, I get nothing to do, so I'm just going to play the market on my phone. That's what's going on. Millions of times over around the world. And these shares went on a tear. But two stocks in particular I will mention today, Carnival and Norwegian. Something has happened with the shares of those companies and the companies themselves since March. Back in March, our friends at Carnival, they had 527 million shares outstanding, approximately. 527 million shares existed at the end of March. Then everything stopped. They couldn't put a passenger on board, and they needed to raise money because every cruise line, you take the big three cruise lines, Carnival, Norwegian, Royal Caribbean, you add them up, they are burning off $1 billion, $100 million a month. 1.1 billion in cash is evaporating every 30 days from their balance sheets just to keep their ships floating, running, insured, making the payments, and maintaining them. And with a skeletal crew, even with layoffs of a whole bunch of their workers across North America, around the world, they still have to keep up their IT systems. They have to keep all of their reservations going. They have expenses to keep a line in existence. These three guys are burning 1.1 billion a month. They've had to raise cash starting in March. The first thing they did was they went to their existing bankers and drew down their existing credit lines. Immediately raised about $1.5–2 billion bucks. Then 30 days later, they realized, oh my goodness, we could be down another 2 or 3 months. We might not be sailing until July of 2020. And so they raised a couple of $1 billion by issuing stock and or issuing bonds. Some of the bonds and some of the notes they're issuing were convertible into stock, and they began to dilute themselves. Carnival in March had 527 million shares outstanding. Right now, Carnival has 929 million shares outstanding. This company has issued actually 402 million shares, fresh shares from its treasury. I keep pointing back here. That's where the treasury is. They issued 400 million shares from their treasury, and they've diluted all of their existing shareholders back in March. There's now, for every share you had, there's now 0.8 more shares in existence. So the value of your participation in the company, if you once owned 1% of the company, You don't own 1% of the company anymore. You now own about 0.6% of the company. You've lost a huge chunk of ownership of your company because there's a whole bunch of new shareholders. And it's like having a party on a Friday night at your house. You bring out a big bag of Doritos and you put the bag in the bowl, and you got 10 of your friends coming around, and they all get a couple of handfuls of Doritos before the Doritos are gone. Well, 6 months later, you have a big bag of Doritos, you pour it into the bowl, but you got 20 members hanging around. So 10, instead of 10 friends, you got 20 friends hanging around. Everybody doesn't get a whole bunch of handfuls of Doritos anymore. They get one handful of Doritos because you didn't bring any more Doritos. Well, this is the problem with Carnival. They have issued 400 million new shares out there to the marketplace. And so if a year ago, if they would have made $527 million a year ago in profit, they would have had $1 a share in profits. 527 million shares, 527 million in profit. Now, if they have 527 million in profit, they got to divide it into 929 million shares. We're down to 55 cents profit. That's bad news. This isn't going to stop because these cruise lines publicly are hoping to start cruising in the next month or two. But in reality, they probably won't sail for another 9 months. They're going to need to raise another $5 to $10 billion to survive the downturn. In the case of Carnival, they might have to issue another 300 million shares. It could be 1.2 billion shares outstanding by the time they get their first paying customer on board the ship. Yet the stock, which was as low as $7, $8 when the Saudis bought in, it's been sitting at $25 a share. Analysts have been raising the target to 30. They're out of their minds. I don't know what they're smoking. I have no idea. It's obvious that you can get doobies legally in certain states, and these guys live there because they're out of reality. You know what they're doing. Norwegian. I noticed that Norwegian also increased their share counts. They had 214 million shares out in March. They now have 315 million shares out. They've added 100 million shares, a 50% add-on to the number of shares outstanding. Same thing with Norwegian. Hit $27 a share last week, 28. They had just finished raising almost $1 billion at 20 odd bucks a share, not even 2 or 3 months ago. And there's stock out there like you cannot believe. There's so much paper floating around, and yet the demand for it is just insatiable. It's just mind-numbing. It's mind-numbing. But again, day traders don't care. Day traders want liquidity. They want to be able to get in and get out, get in and get out quickly. They want to buy 10,000 shares. They want to get a fill at what price, whatever price. When they want out, they want to get out with 10,000 shares. When it's illiquid, when you have an illiquid market, you can't get 10,000 easily, and you can't get out of 10,000 easily. You affect the markets either going up or going down. But with a heavy liquid market, it's great. You can get in and out a lot. For day traders, it's wonderful. For investors, not such a good thing. If you're a long-term investor in Carnival, and you want Carnival to return back to the $55 a share that it was a year ago, you're going to wait an awful long time, because in order for the shares to reach 55 again, with now 400 more million shareholders in the party, with another 200 or 300 million, I think, coming, this company's going to have to make triple the amount of money it made in 2019 for the stock to ever get back to $55 again. There is no way this company is going to make triple the amount of money they've ever made before in the next few years, because one, they've offloaded a bunch of their old ships. They have fewer ships. That means they have fewer cabins, fewer beds, fewer slot machines. They have fewer cruises to sell. They're a smaller company. You don't make more money net profit with a smaller footprint. You just don't. You lose less. You don't make more. They've got new ships coming. Yeah. They even advertised today that Santa Claus was riding a roller coaster on the Mardi Gras. Yay! It's not going to make them a dime of money. That ship will barely replace one or two of the ships they've dumped off. They've dumped off 18 already. I think there could be another 10, because they're beginning to figure out that the CDC, by the time the new people, the new administrators of the CDC, the new administration takes over and the CDC gets back to doing what they do for a living, which is do CDC stuff, they're going to come up with health rules and regulations for cruise ships in and out of the United States. And I think Carnival is going to be under unbelievable pressure, where they're going to have to spend 5 to 50 million, depending on which ship we're talking about, to keep the ships health compliant. They don't have the money. They're trying to hang on right now. They got to raise another couple of billion for this to start the whole startup game, the whole redo the ship game. You're not going to find any of this information in the public press releases that the cruise lines make. They're not going to be talking about this. They're going to keep this kind of quiet. But this is the reality. And so more shares will have to be issued, more cash will have to be generated, raised to pay the bills and to adhere to the future rules and regulations of the CDC and health protocols for sailing to restart again. And it's going to be a lot longer than sooner. Just Bruce's personal opinion. The IPO game. The IPO market, initial public offering. I try to keep this channel, I try to keep it as simple as I can with regards to the English that I use in describing the stock market, so that those of you who are following me, I want you to have confidence that when you watch one of my videos, you watch me live, and I start blabbering on about the market, I'll try to talk about it in a plain English kind of way so that everybody can understand what's going on. Because these Wall Street guys, and they're very well-educated people. As a matter of fact, you can't become a broker nowadays. You can't become a senior member of a brokerage firm without probably a master's degree of something. You got to have some smarts. Back in my day, it ran the gamut, whether you could become a broker or not. But it's getting harder and harder just to be a high school graduate and become a stockbroker. Pretty tough. So these kids who are coming into the biz and who've been around a while, they're pretty sharp and they're very good with the lingo. They're kind of they're like lawyers. They're wordsmiths, and they come up with lingo that just defies all logic and understandability. And so I'm trying to keep it simple. Okay. The IPO market, initial public offering market, up until last week was on a real roll. It was out of this world crazy. About 60 to $65 billion has been raised so far this year by companies going public, where brokerage firms are helping them sell stock to the public and investment funds and get them listed on stock exchanges and take them from a public company to a private company. And so $65 billion has found its way into these entities, these treasuries, and then these companies pay out their fees and legals and listing fees and all that to get public. And whatever's left over, they can use that for business, becoming a bigger company and more successful. So that's a lot of money. But in the world of finance, 65 billion is a drop in the bucket, because in reality, there are companies going public right now that the minute they become a publicly traded company, they're worth more than $60 billion in their actual market cap. What's market cap? The stock of a price times all the shares outstanding tells you the market cap. Apple is a $2 trillion company now. Is that about correct? 2 trillion. All the shares of Apple multiplied by the price that Apple's trading at equals over $2 trillion. That's what market cap is. Let me just take a quick peek of my in my stock market here, and this is the chart here for quotes just on my Apple phone. All of you probably have this. Apple right now is $2.16 trillion in market cap. And so the higher Apple shares go, the more valuable the corporation is, because you multiply all the shares by the price and up it goes. And the same if it goes down. So if Apple went down 10% in one day, the company would be $200 billion less valuable. Simple as that. Well, there are public companies coming out right now that the minute they start trading, they're worth more than $60 billion. Which is the total amount of money that's being raised by Wall Street for all the companies that went public this year. To kind of give you a sense of just how wacky it is. Here's DoorDash, D-A-S-H, DoorDash, trading at $156.78 right now, down $3.22 a share. Its market cap is $49.8 billion. Guess how much money they make? Nothing. They don't make any money. They don't have a profit. They're worth $49 billion, according to the investors out there. We have a $49 billion company, makes zero in net profit. They have sales. They have restaurants signed up. They deliver a lot of food. They got cash flow. They have employees. They've got prospects. The street loves the prospects, but the stock did start off kind of as high as $195 a share last week when they went public. They're now trading at $157. So they've backed off a long way. They went public, I believe, DoorDash, at $102 a share. The rumor was that DoorDash was going to go public something around 75, 65, 75 a share, about 2 weeks before they actually went public. But then the interest in the stock was so high that the shares just kept going up. The IPO price, the initial offering price, the initial price being offered to investors, was going up and up until it went public at 102. Let me ask you out there, how many of you got it at 102? How many of you were allowed to get it at 102? How many of you got a call from your investment advisor, from your brokerage firm to offer you stock at 102? Nobody. I don't know anybody. There's no way. The only individuals, the only groups that were offered stock at 102 bucks a share were the pension funds and the mutual funds, the biggest customers that the Wall Street bankers have. Those are the guys who got the call. And they were calling them saying, it's the interest is pretty high right now. I think I can get you in, but it looks like it's going at 102. Now, some pension funds might have said, if it's going public at 70, I'll buy 5 million shares. But if it's going public at 100, I'm only going to buy 4 million shares. I'm not putting in more than so many dollars into this deal. They regretted it the minute the thing went public. There were probably other pension funds and mutual funds, ETFs and others, who were probably saying, I'll take all you can give me. I'll take every share you want to sell me. I'll take it, whatever the price. I don't care what the price is. 80 bucks a share, 85, 90, whatever the IPO is, I'll buy all you give me. And it was set at 102. The broker called back and said, we got you 1 million shares. That's all I could get you. I got you 1 million shares. It opened at 182 bucks a share. It opened up 80 bucks and went to 195. And all those investors were happy right off the get-go. The members of the public, the general public, you and I, the first price that we were allowed to buy this stuff at was the opening price of the stock, 185. So we were allowed to buy stock at $185 a share, whether we had $185 or whether we had $20. If you're a Robinhood client, you could buy 20 bucks worth of the stock, but it was at a fractional price of 185. It went to 195. That was the high price of that day. And so if you sold out, you made a $10 profit if you had one share. If you had 1/5 of a share, you made $2. Guess who made the big money by selling at 195? It wasn't me, it wasn't you. It was the biggest clients of the brokerage firms. They would have been the ones who would have cashed in on the deal. That's why there were hedge funds out there saying to their brokerage firms, buy me all you can. I wouldn't be surprised if the hedge fund, which deals with 10 different brokerage companies, 20 different brokerage companies, had a call into all 20 of them. I want this stock, I want this stock, I want this stock. And they cobblestoned whatever they could get their hands on. And then they offered the stock for sale in the first hour of trading and took their money and ran. And they made 80 bucks a share. And if they flipped a million shares, $80 million in profits for another hedge fund. Who owns the hedge funds? Do you own a hedge fund? I don't own a hedge fund. I don't have any money in a hedge fund. They don't call me because I don't have any money. They're very well-to-do. Very large players have the hedge. They own the hedge funds. They're the one. That's their money. They're the ones who've got the billions in there, and they're making millions and millions on these deals. The IPO market, Airbnb, $68 price to the public. The IPO price. Again, the very few members of the public got in at 68. First trade, 146. After going public at 68 bucks a share. I'm just looking at my notes over here. Right now, 126 a share. DoorDash is down to 155. It's off 40 from its high. Airbnb is off about 40 bucks from its high. And but anyone who paid the initial price, 68 or 102, in both of those cases, they're laughing. They're still up. They could have been up more if they sold, but they're still up. There are a lot of employees of these companies, especially Airbnb. Airbnb has been around since 2008. There have been a lot of employees who've been with the company since 2009, 10, 12, 14, 15, 4, 5, 7, 8, 12, 10 years, who were given stock as part of their compensation. They were earning shares in a private company over years. And I'm sure that there are some people in that company, employees, just regular folks, who are owners of 1,000 shares of stock. Well, at 126 bucks a share, they got a bit of value there. And I heard something today that came out from on the business channels. I was watching CNBC. They were talking about can't remember I think it was Snowflake, the company Snowflake, which went public at 120 bucks a share, opened at 240, went as high as 429. It's now trading at 322. Apparently, today or tomorrow, a lot of employees of the company will be allowed for the first time to be able to sell any of their shares if they want to into the open market. And there's worry by the market at large. Analysts are worrying, oh, wow, all these shares could be coming up for sale from the, quote, employees of the company, so-called insiders, not that they have enough shares to matter. This could be a downer on the stock. And so the stock was under a bit of pressure today. But the reality is that Snowflake, down $4.99 a share, by the way, these employees are not necessarily going to sell their stock. But what could happen is I could very well see where an employee does have 1,000 shares of the company, of Snowflake, $323 a share right now. They have $323,000 worth of stock that they now could sell if they wanted to. Well, you know what they can do with that stock today that they couldn't do a couple of days ago? They can use it as collateral against a loan. So they might be able to go to their local banker in their hometown and say, hey, look, I want a line of credit for $50,000. I'm going to pay off my credit cards. I'm going to pay off my car loan. I'm going to sink 10 grand into my house a little bit. I want 50 grand. Here's $323,000 worth of stock as collateral against the loan. And the banker's going to go, oh, come on in. I'd be happy to talk. We'll give you a loan at prime plus 1%. No problem, because that company isn't going out of business. You have a job there. You've got the stock. You've got options for more. Eventually, you'll have even more shares. And if you ever need to pay off the loan in a hurry, all you got to do is sell some stock in the open market. And as long as the shares stay at $50 or higher, you can pay off the loan with just the stock. No big deal. But we'll give you a line of credit. Just pay interest on the money. And it's all good. Well, at 3% interest for a cheap loan, $50,000, that's $1,500 a year in interest, $125 a month. How would you like to borrow $50,000 for $125 a month? Not a bad deal. Just use the paper as collateral. It's even simpler than that. This employee could literally put the shares in deposit in a brokerage account with Fidelity, Schwab, whoever they want to use, open a margin account, and withdraw cash on margin. They can literally borrow against their stock, cash, take the cash, and spend it when they need it, and pay brokerage interest rates, which 2.5%, 3%. It doesn't mean they're going to sell the stock. They can now use the stock for economic benefit and gain. However, there are probably a number of employees who are going to say, you know what, I can take these shares that were worthless to anyone else, but they're now worth something because they're free trading stock. I'm going to take some shares and deposit them into my retirement plan, my IRA, or my whatever my plan is. And I'm way behind in saving for my retirement. I'm 45 and I've been with the company for 8 years. I'm going to put $100,000 worth of stock into my IRA or whatever the instruments are in the US. In Canada, we call them RRSPs. And I'm going to start building for retirement. I keep the shares in there and let them grow in value in there from here on out. And I'm going to be employed for as long as I can with the company. Hopefully they'll not let me go and they'll keep growing. And I'll be with the company for the next 4 or 5 or 10 years. And maybe in 5 or 10 years I'll retire, because by then I might have 4,000 shares of the company. And if we're trading at $500 a share, I get $2 million worth of stock. I'm going to retire on the value of my portfolio. This is what's going on with the share releases. So don't be fooled when you hear talk about stock analysts going, oh, the market could be under pressure for this stock because a whole bunch of insiders are going to be allowed to sell their stock starting Monday morning. A lot of insiders don't ever sell their stock. They don't want to sell their stock. They're in a growing company. They've bought the Kool-Aid. They drink the Kool-Aid. They have 10,000 shares free trading now, and they've got 30,000 more shares coming their way, free trading over the next 2 years. They'll have 40,000 shares in the next 2 years. They know what the future prospects of the company are because of how busy they are at work and how many people are being hired all over the place to grow the company. They know that shares will keep on running right along. Eventually, these companies start turning a profit. When they start turning a profit, then the thinking goes, well, maybe we should start paying dividends for our shareholders. Well, if you're an employee with 50,000 shares and you're getting $1 a year dividend from your employer, from the company, because you're a shareholder, you're getting $50,000 a year in dividend income just being a shareholder. Why would you ever sell the stock? You can now literally retire and just collect dividends and live on 50 grand and whatever other pension funds you've saved up or whatever savings you have. This is the American dream. This is how it works. But the IPO market has topped out right now, where It was thought that when DoorDash was going to go public at 65.75, and they ultimately went public at 102, the thinking was that the bankers have maxed out the amount of money that DoorDash can get for the initial offering of stock, $102 a share. Well, they were wrong. When the stock opened at $182 a share, excuse me, the company ended up leaving $50, $60 a share on the table for every share that they were offering. And so the underwriting actually was a disaster. It was a success for some people. The pension funds who got in at 102 and who could now get out at 185, 195 just on the first day, they're all happy. The brokers are happy because they earned a commission to issue the stock at $102 a share, and they're now earning commissions to flip the stock as it's trading on the open market. They're happy. But the company itself and the employees of the company, they're sitting there going, well, we raised, I think it was a $3 billion raise, but we could have raised $4.5 billion. That's how much interest there was in our stock. We left $1.3 billion cash on the table. Now, in theory, all the owners of the company, the original owners, the founders of the company, the employees, the founder, the creator, they're all worth a lot of money. They're worth $185 a share on the first day. They're still worth $155 right now. They're all up. They're all ahead financially. But the company that they are working on, the entity that they're trying to grow, lost out on over $1 billion in cash last week. When's the next time they're going to get that opportunity ever again? Never. You only go public one time. You have to go public the right way. You got to score. Now, there's nothing wrong in going public at 102 and having the stock trade at 115, 120. That's great. That's a successful underwriting. That's normal. That's kind of normal. But having a company go public at 102 and start trading at 180, that's not normal. That is beyond reasonable, and that means mistakes were made. And investment bankers let their customer down. They let their client down. They left them hanging for over $1 billion that they could have had. That's $1 billion more that DoorDash could have in its bank account right now to grow even faster and even more, even larger. If they could have had that extra money to buy a competitor out, or to just become that much bigger quicker. That's how IPOs work sometimes. But for the public, the average investor, you and I out there, we don't get in on these ground floor deals. The only way we can get in on a ground floor deal, the closest we can get, is on something called a SPAC, a special acquisition corporation. It's the only way we can get in as close as possible. A SPAC is a company that gets listed on the exchange that has no business in it other than cash. It's only got cash in it. And it is looking for a company to acquire on a reverse takeover. In other words, you have a public company with a bunch of cash in it, maybe 400 million, 500 million in cash. It's a lot of money. And what it's looking for now is a private company over here that it can buy up. And the private company might be a $2 billion private company. And we have a $500 million public company. The $500 million company buys the $2 billion private company. Well, how do they do it? They issue stock to the owners of the private company. That's how they do it. They just go back to their treasury and issue stock certificates. So now the company's worth $2.5 billion, $500 billion in cash, $2 billion in value. It's a $2.5 billion company, all in one umbrella. The owners of the private company own 80% of the public company because they have $2 billion of the $2.5 billion of value. The initial SPAC investors own 20% of the public company because they had $500 million of the $2.5 billion company. But the company as a whole is now a public corporation with $500 million cash in its bank account. And it can now go forward and expand its business, now being a public corporation. All the employees of the private company who had shares of the private company now have shares in a public company. They've become liquid. This is a big deal for all employees, a major motivator for employees to stick around. And sometimes instead of getting a salary of $4,000 a month, they get $3,000 a month in cash, but $1,000 a month in cash in stock. The stock might be issued to them at $5 a share, $2 a share, $1 a share. So they're getting 1,000 shares a month plus $3,000 a month. And for 5 years, they're loyally hanging around, growing with helping the company grow, getting it bigger and bigger. And every month they're earning 1,000 shares of stock. After 5 years, 60 months, they have 60,000 shares. The company gets bought up by this public SPAC and becomes a public company. The SPAC is a $10 company per share. And it now melds one to the other. And if the shares are trading at $15 a share, when it's all said and done, the 60,000 share employee has 60,000 shares worth $15 a piece, $900,000. Not a bad payoff for 5 years of not getting the cash. Living on $1,000 a month less in cash, you've got a $900,000 payoff. This is the success. Doesn't always work that way, but that's how it can be. If the SPAC goes to $20, $30, $40, $50 a share, this employee is worth even much, much more. Of course, they're worth millions. That's the American dream to the ultimate. The founders of the company are millionaires going in, they're billionaires coming out. So fair enough. But again, they're unlikely to sell any of their shares because the salaries they're getting are quite reasonable to live on. And they're just getting more and more richer. But you, as an individual investor, you can buy SPACs at the issuance price or very close to it. There are a lot of SPACs right now that haven't acquired their private company yet. They're trading at 10 to 12 bucks a share, dozens of them. And you can go out there and you can buy a couple of SPACs and take a chance. Buy 100 shares or $1,000 worth or whatever you want to do and pick up 4 or 5 different SPACs and just sit on them and wait for them to do their acquisitions. Find out who's managing the SPACs, who created the SPACs, who put the money into these SPACs. I was watching today on CNBC, a gentleman named Spencer Roscoff. He originally created a company, was the founder of Zillow, which is the online real estate company where you can find the value of any house in the United States and see what the markets look like and look at those satellite maps and zoom in on your own house and see what your house is worth and the houses all around you, Zillow.com. This guy created Zillow. He has now created a SPAC. He's got a SPAC and it's funded with a whole bunch of money and he's looking for a deal. Now that's the kind of guy that I would invest in. I would buy $10 stock and give this guy a chance, because if he doesn't buy a company in the first 2 years that the SPAC exists, you get 10 bucks back. You have to refund the money. They have to vend in a company within 2 years. Now, if the company they vend in is a dog and the market doesn't like it, the stock can go less than $10 a share and you don't get any money back. But if the company they're buying has prospects, and I suspect that this gentleman kind of knows the difference between a winner and a loser, the shares will go up in value. How much? I don't know. Maybe only a couple of bucks. Maybe they'll double. Maybe they'll triple. Who knows? But I suspect they'll do more than inflation, because inflation is 2-3%. I think they'll do more than that over a year or two. And that's where you can get into an IPO at an IPO type price rather than try to play the Airbnb, DoorDash, or Palantir, or Unity Software, or Snowflake, Asana, JFrog, Lemonade, all these other IPOs that went public and just took off and left everyone else behind at the bus station. Here, you can get in at least at a reasonable ground floor price of 10 bucks a share, 12 bucks a share, 11.50, and take a run there. It's kind of like being an employee in a way and just kind of sitting around and waiting. Just put up some cash, buy it, hold, and wait. There you go. Anyway, we'll see what happens with these shares going forward. I want to say hi to some of you folks who have been patiently waiting for me to read some of my comments. If you have any questions about the market, whatever, let me know. I'd be happy to do about that. Let's see. Shane, hey, Bruce, great call on getting out of Royal Caribbean 84. Could be months before it's time to get back in. Jimmy Wilkes, amazing how technology changes everything. James, welcome. Hi, Bruce. Buy Tesla now or wait until S&P 500? I wouldn't buy Tesla now at all. It's about to become part of the S&P 500. The minute it's in, there's no reason to hold it. It's over. If I were a shareholder of Tesla right now, I would be either selling out or I would be buying puts to ensure my holding, because I think the shares are topping out at their top number. I could be wrong. I mean, this thing is so volatile. There's, the stock can move, 10, 20, 30 bucks in a day. Today, Tesla, here we go, dropped $6.42 a share today. Didn't do much. Dropped $6.42. But this is a 3-month chart from the mid 400s up to 655 post split. This is the last month of the stock. Look at that thing from way down there up to there. It's been crazy. But I think in the last week or so, we've been topping out. There's the last week. It had a little dip, but across, it's right at the top here. This might be it. This might be it for the upside. There might be one more little upshot on the day of inclusion, maybe not. I would not play with fire. If I didn't own the stock and I wanted to make money on the downside, I would look to buy an out-of-the-money put contract for as cheap as possible, have at least a 3-month window on it, maybe longer, and sit back and wait. So if I could own if I could get a put position in for a couple of $1,000, I'd be happy to have that. I would then be shorting 100 shares of the stock with one contract. If I could buy two, I'd buy two. But if I had 100 shares and they drop $200 a share over the next 3 months, then I score a little profit on that deal. Maybe I can take $3,000 and turn it into 6 or 8, 9. It all depends. But you really want to know what you're doing. If you own the stock, like I said, I don't see upside from here to any great extent anymore, because once you're in the 500, you're in the 500. And now why do you want to buy the stock? You want to buy the stock because it's trading at 1,500 times earnings. I want to buy it because it might trade at 1,800 times earnings. I don't think so. It's overpriced. Kirk, hi, Bruce. Kirk from New York. Hi, buddy. How you doing? Nice to see you today. Shane, this guy is a walking wealth of knowledge. As a new trader, I'm learning so much caution and restraint from Bruce that will hopefully save me if a crash or bear market comes around. Shane, thank you for that. I've seen crashes. Oh, man, I've seen them. Stock markets go up nice and slowly, generally speaking, but when they crash immediately, and they crash suddenly, and they crash a lot. Sharon, hi from Central New Jersey. Hello, Sharon. Howard Green, hi, Bruce. Waiting for the snowstorm here in Long Island. I am there on YouTube. Thank you, Facebook user, for being here. I'm simulcasting on Facebook and on my Stock Markets with Bruce channel on YouTube. Shane, what happens when orders are put in after market hours? It depends on the brokerage firm you deal with. There are certain firms you can deal with where you can buy and sell stock after hours and pre-market. You can do what's called pre-market trading or after-market trading. Do some research on Google, find out who they are. If you want to open an account with them, good luck to you. But those markets are very volatile because the liquidity isn't there. You might only have 5 or 10 players on each side of a market, whereas during market hours, there might be 500 buyers and sellers simultaneously all around a stock price. So you got to be careful with aftermarket stuff. Facebook user, hi, Tom Henry. Shane, also, how indicative are pre and post market movements? I've seen pre-markets where a share goes up $12 a share, and then on the opening trade, it's only up $2 a share. I've seen the reverse. I've seen where it's been up $2 a share on pre-market, and then it opens up $5 a share. And the reverse on the downside. The volatility can be worse or less. Pre-market and post-market is it's Wild West. It's the Wild West, and you've got to have some nerves of steel, and you really got to be able to take a loss and handle it, because you can get burned badly either pre or post-market. It can get you. You got to be careful. Sharon, Howard, where are you on the island? I grew up in Dix Hills. Howard, Port Jefferson. Back in my day, it was way out there, but I know today things are developed way further east, all the way to Greenport, he says. All right, it's a long way out. SLGCs, Bruce, Duolingo, the language learning website ad, is talking about going public next year. Do you have any thoughts on whether that would be a good investment? I have no idea. Know nothing about them. I never heard of it, so I can't grant you that. Shane, have you ever used the app? Although it's well known, I don't personally know anyone who's picked up a language from its usage. No returning users, not a great investment, in my opinion. Shane, I use it online. I work on French every day, which is something I studied in school. I will never be fluent, but I have a good reading understanding of the language. Up until recently, I also studied Spanish with them, and it has gotten me through airports, etc. And I even picked up some Italian and Catalan phrases before my cruise out of Barcelona last year. It definitely came in handy. There were a couple of cabbies who wouldn't have dealt with us, but for the fact that I knew Catalan greetings. So there's a handy thing there. Hi, Bruce. Dimitri from Russia is here. What do you think about Carnival? Down. It's going down, going lower. They're way too leveraged. I also have the ability to speak French, so long as it's being spoken to quickly. I hold my own, says Sharon. Stephen Farrell. Sorry, Bruce. I just joined the live stream. How do I find a SPAC? Look for SPAC is what the acronym is, the short form. Go to Google and just say SPAC stocks, SPAC stocks, and you'll find all kinds of names from that. All kinds of outfits show them. Sorry for my English. No problem, Dimitri. Jimmy, great explanation of a SPAC. Do you have a ticker for Raskov's handy? I think his company is called Supernova, his SPAC, I think. It didn't show it on the CNBC interview, but I suspect that his name of his SPAC is called Supernova. So check that out and see if you can find anything on that. Otherwise, enter his name, Spencer Rascoff, Rascoff. Enter his name on a Google search, and you'll find the SPAC associated with him. That's one and the other. Okay, give that a try. SPACs are an interesting way to get into the market, an interesting way to get into the IPO market. Just so you know, this year, $65 billion was raised from IPOs. $60 billion was raised this year from SPACs. And the thinking is that next year, SPACs could be double that or more. There could be much more money raised in SPACs next year than this past year. This year was unbelievable. So we'll watch that one too. It could be most interesting on the SPAC front. As far as the markets go, kids, I'm old school. I measure stocks by what's called a PE multiple, price earnings multiple. And that means simply, like I said earlier, if Carnival made a profit earlier this year of $527 million and they had 527 million shares outstanding, they were earning $1 a share. In my opinion, Carnival could trade at a 15 times earnings multiple to be reasonable. And that would make it a $15 stock. $15, 15 times $1 per share earnings is a $15 stock. PE multiple, price earnings. So today, Carnival has 929 million shares outstanding. They make no money, zero money. They don't make any money. So they don't have a PE multiple. They have a negative PE multiple. They don't have a multiple. The stock's at 21.55 right now. That's where it closed at today. It's trading in the aftermarkets now at 21.59. But 21.55 is the price of Carnival stock right now. There is no PE multiple on this stock. If they were to earn $929 million next year, with 929 million shares outstanding, they would have a $1 per share earnings multiple. And in my opinion, they would be trading at $15 a share. That's what they should trade at, 15 times earnings. They're trading at 21.55. So they have to make about $1 billion to justify a $15 stock price. I don't see them making $1 billion net profit until 2024. And that's hoping they make it. I don't know if they're going to make it. I can't guarantee it, but that would be the earliest I could see it happening. 2024. Stock is at 21.55 right now. Is it overpriced? In my opinion, oh yeah. On the fundamentals, it's out of this world, out of this planet. And yet analysts are calling the stock to go to 30. I don't know how they're coming up with it. Do they think that the company's going to make $2 billion next year in profit, justifying a $2 a share price earnings per share, $2 earnings per share, and at 15 times earnings, that's $30. Is that it? They're not going to make $2 billion next year. They're not going to break even next year. I don't know how these analysts are coming up with these numbers. I don't know how far out they're thinking. They got to be thinking 5 years out, but I don't think they are. I think they're thinking in the next 12 months. And there's no way this is going to happen. There is just no way on how this is going to happen. Price earnings multiples. Now, to be fair to the market and to be fair to all of you out there, don't want to mislead you in any way. Let me show you some price earnings multiples right off of my telephone. Right, this is Apple. Okay, right here. If you take a look at there's the chart. There's today's price, 127. What was that? 88. Right. Sorry for the blurriness. I'm going to get rid of this comment so you can see the full screen. Here we go. All right. There's the price of the stock today. Here, let's do this. One day. This is today. Here was the opening trade, the high of the day, the low of the day, and right here, volume today, 150 million shares traded. Price earnings. Can you see that right there? 38.99. Apple trades at 38.9. Let's call it 39 times earnings. That's what Apple trades at. 39 times earnings. What's a reasonable price for Apple to really trade at on a PE multiple? It's not 39. That's too high. This is an old school broker talking. When I was a broker in 87, in 79, a 12 to 15 time multiple was called generous. If this stock was trading at 15 times earnings, it would be trading at less than half this price right now. It's trading at 127.88 at 39 times earnings. And it went up today, which means people think they're going to earn more money next year than last year. They're probably right. I think Apple will make more money next year versus last year. But how much more? If they make 10% more than next year than last year, then the PE multiple today is 39. The PE multiple for next year might be 35. So the stock is trading at 35 times next year's anticipated profits. All right, that's PE multiple trading. That's PE multiple thinking. That's too high. It's still 10 times minimum too high for Apple. 25 times earnings is incredibly generous for Apple. 39 times earnings is ridiculous. But let's look at some other stocks. How about Microsoft? Microsoft is a company been around a while. Today closed at $214 a share. It's trading at 34.5 times earnings. At generously, 25 would be reasonable. 15 would be a little conservative maybe, but 34 times earnings, too much. There's no way Microsoft is doubling their profit next year. They're too big to be able to do that. It can't be done. All right, let's see other stocks. See if I can get this one in here. NVIDIA. Do you know who NVIDIA is? You ever heard of NVIDIA? NVIDIA is a chip company, darling of Wall Street, trading at $534 a share today. PE multiple 87.3. Market cap $330 billion. This company is a third of $1 trillion in value. Unbelievable number. 87 times earnings. If they double their money, if they doubled their profit between this year and next year, all right, they're not going to, but if they did double their profits, the stock is trading at 43.5 times next year's earnings. This company won't double their profit for 2 or 3 years. They're big, but they're not going to double their profit in 1 year. This is insane valuations. Here you go. Bank of America. You heard of these guys? Market cap, $247 billion, trading at 14 times earnings. These guys have all the money. This is where all your cash is. They own Merrill Lynch. They're a huge outfit. They're, like I said, $247 billion market cap, trading at 14 times earnings. They're not the darling of Wall Street. Yet they will make more money next year than this year. Maybe 5% more, maybe 10% more. But if they did earn 10% more next year, that means they're trading at 12 times next year's earnings. They're actually a bargain. They're cheap, but they're not sexy. And there's the problem with these kinds of stocks. The bank stocks are not sexy enough for the day traders. And they're not volatile enough for the day traders. You take a look at the stock right here. You can see here the high and low for the day, 28.25 for the low, 28.82 for the high. The stock only traded in 60-cent range. Not enough action for the day traders. The day traders want dollars of movement. They want dollars. If they can buy 1,000 shares and make $1, they make $1,000. If they buy 1,000 shares of this and make a dime, they only make $100, but they could lose $200 if it goes down 20 cents. They want dollars of action and they want to take the swings. This isn't sexy enough for the day traders. And so that's why this stock is trading such a low multiple. Very conservative, but a company's going to be around a while. Let's take a look at some others. Here's a company that blows my mind. This company doesn't make any money right now. They're not making any profits. The shares are trading near their all-time high for the last 52 weeks. This might be their all-time high period. The company's worth $314 billion. And it ranged today, went up $470 in price today, and it ranged from $167 to $174. Had a $7 move up and down today. Who am I talking about? The Disney company, Walt Disney. This company is a cash flow machine normally, but with the theme parks shut down, they're bleeding money. They've laid off 30, 40,000 people already. They're going to lay off more. They're not making any money over there. Yeah, certain divisions are making money. The Disney Channel is getting a lot of subscribers. ESPN, ABC, they own media companies. But the stock is being recommended by analysts, even though they're not making any money. They're trading at all-time highs, They're telling people to buy. There's no PE multiple. Look at the blank over here because there's no earnings. There's no money. They're not making any money. This is an overpriced stock, in my opinion. This shouldn't even be at 100 a share. Shouldn't be at 100 a share. The speculation is nuts. But what's the thinking out there is, well, when the vaccines are all, distributed, the people will be going back to Disneyland, and it's going to be great. Really? You think that Disneyland's going to be able to offer their services with 2-hour lineups, packed in like rats, waiting 2 hours to get on a roller coaster? That's not going to happen. They're going to be restricted to 30, 40% occupancy for the first year. Folks are going to have to wear masks. They're going to have limited numbers of people up there. They're barely going to break even on their parks. This stock is so overpriced, but the market loves trading. They love the action. It traded 15 million shares today. So if you want to get in and out of 1,000 shares like crazy, easy to do. 15 million shares traded in 6 hours. Yeah, that's what this market is doing right now. It is that frothy, that out of control. Any more I can tell you here? Okay, Netflix. We all love Netflix. $519 a share, 84 times earnings. 84 times earnings. They just sent us an email last week. They want to raise our price by $2 a month. My wife and I are seriously talking about, I think we're going to drop them. I don't think we're going to keep them anymore. Because when it used to be $8 a month, it was great. Then it went to $10 a month. It was all right. But what we noticed was they started coming out with their own content. And I understand from a business point of view why they would do that, because if they own the content that they're broadcasting, they then don't have to buy as much outside content to other studios, and they can, produce their product and then show it forever on their own service and not have to pay royalties on it. In the long run, they make more money if they produce good content. But I want Netflix because they had all the movie studio stuff. I liked watching United Artists, and I like watching Fox, and I like watching Disney movies, and they don't have those anymore. Their offerings to me are getting narrower and narrower, in-house offerings. They're an HBO. They're becoming an HBO, broadcasting mostly their own stuff. It's now it's going to be $18, $19 a month here in Canada for this service. I'm having a tough time justifying that cost. I might drop them. And this could be a problem for the stock because their income is from subscribers. And if their growth rate starts to slow down, then that PE multiple of 84 times is going to become a nightmare for this stock. This stock could go back to a 45 times earnings multiple at any time. That would drop this stock by 50%. If 5% of their subscribers don't renew and say, I'm not paying the extra couple of bucks a month, forget it. You guys want to keep the subscriber numbers? You got to get a bunch more because you're losing your old ones. You got to replace the old ones with new ones. Well, there's only so many new places to go at $18 a month. This is getting expensive. And so I think Netflix might be a little too high here. These might be the last days of the good old days for Netflix. They were as high as $575 in the last year. They did hit that in August. Here's a chart for 1 year, and here's the August timeframe right here. And you can see right there, that's where the shares hit the high. But they haven't been at $575 since. That was $575 a share was the high for the stock. It's now $519, and they want to raise prices. I don't think it's a good idea. If the pandemic is going to be over in the next 6 months to a year, as these vaccines come out, more and more people will not be on lockdown, which means we'll get out, which means Netflix's ride might be over for a while. Google, here's Google. 1 day chart on Google, up 771 to 1,767. Price earnings, 34 times. Kind of a little less than Apple, kind of like Microsoft. Not like stupidly priced at 80 times earnings, but it's still too high. Very interesting. Other company, Snowflake. Snowflake at $328 a share, 0 PE multiple. They don't make any money. They haven't made profit yet. This is going to take a while. This will be interesting to watch. As I say, PE multiples are a sign of market volatility or frothiness. overpriced as sometimes bargains. And I have a tough time justifying wanting to be into a stock that has no PE multiple and is trading at hundreds of dollars a share. I have a tough time wanting to be in something like that. All right. Let's see here. Just want to get back to my comments and I'll catch up with you guys, okay? And there we go. And Cabby's right. Here we go. I also have the ability to speak French. I did this comment. Thank you. Just joined the stream. How do I find SPACs? And that we talked about how you get a hold of Mr. Roscoff's SPAC. Stephen, thanks, Bruce. Jimmy, so Supernova is the name of the SPAC, and he's looking to purchase a private company. I think so, Jimmy, but look up that guy's name and you'll find the info, because I was watching the interview today, haven't had time to follow up on this. Shane, you mentioned how companies like Tesla were way overvalued at 1,000 times PE. What were stable PE numbers prior to this bull market? In the 17 range, 15 range was stability. Into the low 20s was getting frothy. Into the 30s, ridiculous. 80s, out of this world. 1,500 a share, no, not in touch with reality. Tom Neppy, what stock app are you using to show us the current value? I'm just using this app from my Apple phone. Here's the app that's built in right here to my Apple iPhone. I think it's a Yahoo app. I believe, I don't even know. Yeah, it's Yahoo Finance. I think you can get it for nothing. Jimmy, Tom, that'd be Apple stocks on iPhone. Dimitri, thank you for your opinion, but with the end of coronavirus and deferred demand, that the stock will soar by 30-50%, in my opinion. Well, that's what makes the market what it is. Everyone has their opinion. Shane, does Peloton's induction into the NASDAQ 100 mean all other companies will buy into Peloton the same way Tesla joins S&P? Possibly, but because Peloton isn't as valuable as some of the big 100, it's going to be minimal. There'll be some buying, but it won't be that much. Bruce, what about Along Therapeutics? Is it interesting price? Don't know anything about them. Tom said nothing there. Sharon, this particular year, Netflix is showing movies that we normally would have to see in theaters. Come Oscars time, it'll be very nice to be able to watch nominated films at home. Interesting, true. And Sharon, Googling Google is very meta. Yes, that's true. Google I kind of work for Google in a roundabout way, because Google owns YouTube and I'm a YouTube creator, but I don't have any shares of Google and I don't have any stock options in Google or in YouTube. I'm just a YouTube creator and just trying to make a go of it here. But big company, massive machine, successful as all get up, 34 times earnings. I think a little overpriced by about 20%. If it were, 400 or 500 a share lower, it would be fairly priced. But this is the market. The market is overvalued across the board. There's so much cash sloshing around. Interest rates are virtually nothing. You either buy a 10-year note from the U.S. Treasury and get 0.9% on your money for a decade. Go to your local bank, buy a five-year guaranteed investment certificate. What are you going to get? Point and a half? Or buy stock and have it go up 5% in a week, depending on the stock and the company. You can also just buy stock like bank stock or others and just take the dividend. And you'll make more money on the dividend on these shares than you will holding a GIC. I mean, there's nothing wrong with that. Here, JP Morgan, 120 bucks a share. You can buy that stock and you will get a yield of 3.4% on your money. It's right here, the yield on holding the stock. So you can buy a 10-year Treasury bill and get 0.9%, or you can buy shares in JP Morgan and get 3% on your money. You'd better off holding JP Morgan. And that's just this one. There's all kinds of companies out there who pay a dividend, some yielding higher, some yielding lower. Let me take a look here for some others that might pay a better yield. Let me take a look here for, no, Microsoft is 1%, forget it. Goldman Sachs, 2% yield. That means the lower the yield, more of a growth stock it has to be, because you're not going to get rich on the dividend. Morgan Stanley, 2.2% yield, not exciting. No yield on Facebook that I know of. Nothing on eBay, Twitter. Now, if you go to Canada, Royal Bank of Canada, for example, you buy the Royal Bank of Canada in Canada, it's 82 bucks a share Canadian. You can buy this on the New York Exchange in U.S. money. Yield on this, 4%, right there. 4% yield on Royal Bank of Canada. This is Canada's largest consumer bank. Solid as get up. Make more money year after year. And they usually raise their dividend every year or so. 4% yield, that's pretty good compared to a GIC. You go to the Royal Bank of Canada, you give them money for 5 years, give them $5,000 for 5 years, they'll give you 1%. Buy their stock, they'll give you 4% on the money. You just got to take it. You just got to take a chance on the value of the stock. That's the difference. A GIC, you gave them $5,000, you're getting back $5,000 plus your interest. Stock, you're giving somebody else the $5,000 because you're buying their shares from them. But the shares carry a yield. You're the registered shareholder. You're going to get 4% yield, 1% every quarter on your money for as long as you hold the shares. But the shares might be higher, lower, or the same 5 years from now. So you got to ask yourself, which way do I want to go? A lot of investors are saying, I'll take the stock risk and put the money in the market rather than put it into long-term GICs. Absolutely. There are people out there who are taking their mortgages, their homes, they're taking their homes and they're borrowing money against their homes using second mortgages or renegotiating their first mortgage, maximizing up their mortgage, taking the cash, putting the cash into the stock market and trying to grow it there. Because the money that the interest rate that they're paying to get that cash is a mortgage interest rate, 2.5%, 3.5%, 4.5%, depending whether US and Canada. Here in Canada, we have mortgage rates now below 1%. In many cases, you can borrow money on a first mortgage at 1.5%. So people are borrowing money at 1.5% in Canada, turning around and buying Royal Bank of Canada stock and getting a 4% yield, making a 2.5% profit on the difference of what it costs them to get the money versus what they're getting for their money, but they're taking the risk on the stock and on their house. So as long as they can make their mortgage payment, they'll never get a call on the loan. And on the stock itself, the Royal stock, if in 10 years, the stock goes from 84 a share to 104 a share, they've made $20 on the stock, they've yielded 4% today, and hopefully they're yielding even more by the time 10 years goes by. And they've paid down their mortgage for the next 10 years. So they owe much less on their mortgage. They are much more valuable for their house and the stock, and they've earned income. And that's called economic success if you can stand the risk. There you go. This is how people make money with money. You make money with money. Now, in the professional business, you've got billionaires who own skyscrapers, shopping malls, and they leverage those at mortgage rates, use that money to build more buildings and shopping malls, or they diversify their portfolios and they buy shares in publicly traded companies or bonds in publicly traded companies or other companies. Like how about buying bonds in Carnival, where Carnival is paying 10% interest. They're buying Carnival bonds, getting 10% interest, but only paying 2% interest on their mortgage, on their shopping mall, and taking the 8% spread. The risk, of course, is will Carnival be able to pay the interest every year and eventually pay off the bond at the end of the bond's lifetime? Will Carnival still be around? That's why they pay 10%. You got to gamble. The more you gamble, the more you make, the more you can lose. Welcome to today's investment world. There you go. I hope I haven't confused too many of you. I hope I've kept it simple enough to make it in English to understand just what's going on. Let's see here. Thumbs ups of Space Force Cooks. Thumbs up late to the show. What do you think of Bitcoin? I don't trust Bitcoin. I'm old school, so over the age of 50, so I avoid it. I just cannot get my head around a currency. I also am fearful of an entity that could turn around and be taxed by tax authorities worldwide at any time, in any way they see fit. I'm not a believer in Bitcoin. White Knock, GE, GameStop, Carnival, Norwegian, Royal Caribbean, all kinds of stock. Shane, what are your thoughts on some current TSX energy stocks? Get out of oil and gas. Get out. There is no upside for oil and gas. There is so much of it. There is so much oil on this planet available at a moment's notice to satisfy any surge of energy need or demand. The Russians are drowning in oil. The Saudis are drowning. The OPEC nations are drowning. The USA is drowning. Canada is drowning. The big oil producers have got oil and they can't get rid of it. They can't drop the inventory levels. And there is so much production waiting to come online on stream at a moment's notice. There's too much of it. And the future is away from oil, because for the betterment of the planet, we should burn less of it and use more alternate energy needs, like shining a solar panel, having a solar panel on top of your roof, absorb the sun, turn that into electricity, and use that instead. Use that if you can to charge your car, if you can go that far, or partially charge your car, and use less oil. Oil is out, and I would not get in there right now. Many analysts talk about a big infusion of unsecured money and overheated market. What do you think about it? Is it possible to collapse? Yeah, eventually, yes. What reasons are the markets at such high levels right now? Lots of cash in the market, low inflation, low interest rates, people thinking about a recovering economy going forward. All this is here. All this is happening. We have a new president coming into town January the 20th in Washington. Being in Canada, we watch that closely. The minute he takes over, it's all different. The free ride is over for easy, cheap money from capital gains. There might be capital gains increases, but I don't expect it for a couple of years. But I can see environmental rules coming back to sanity, and it'll be more expensive for business to be in business because they're going to have to be responsible with the ecology, little things like that. But once the recovery happens with respect to the pandemic, once that sort of eases up a bit, and I hope it's sometime next year, there will be a shift away from at-home stocks to value stocks. There'll be that. There'll be a lot of adjusting. But I think there's inflation coming. I think inflation is coming because I believe that there are currencies out there, not U.S. currency necessarily, but other currencies out there that are overvalued, and they're going to become undervalued. And they're going to need more U.S. dollars to make ends meet. They're going to need more of their dollars to make ends meet because they're up against the U.S. dollar, which is so powerful. And I think the secondary economies are going to be in big trouble going forward. Not all at once, not overnight, but slow but sure, there's going to be a deterioration. It'll be interesting to see how the markets react to this. When companies are global and are trying to grow on a global basis, selling goods and services globally, and then the global market does a slowdown, or certain areas slow down that weren't growing like they used to grow, or they're growing, but inflation is taking away your upside, you're going to have issues, and interest rates are going to start to go up. And with higher rates, we're going to have casualties. Space Force Cook, my buddy, did a refi on his home. Thought he got a great deal thanks to lower interest. Was 10 years into a 30-year fixed, refinanced to another 30 years and paid around £10,000 fees to refi, and he got screwed. Very interesting. Sean Murphy, thanks, Bruce. Still learning. I'm learning every day. I keep learning more about this world and this market every day that goes by. It is an absolutely fascinating game, but you got to stay on top of it. You got to pay attention. And if you're into it, it's kind of cool. Very interesting, Bruce. Thank you, Don Quixote. Everybody, thank you for being here. If you could throw a thumbs up for this live show, I would appreciate it. Help this channel get discovered a little bit more. Please consider subscribing to Stock Markets with Bruce if you'd like to follow what I'm going to be doing here. We're going to keep bringing out videos from time to time, talking about what's going on out there in the market in a plain English kind of way. We'll go public from time to time and just hang out. You're more than welcome to participate. Ask me whatever you think. I'll do the best I can to answer questions for you if I can. If I can't, I'll tell you I can't. But thank you for following this channel so far. We're over 1,000 subscribers now, approaching 1,100. Fantastic. We got notified last week from YouTube that we're now a monetized channel. So thank all of you who are primetime members who are spending time with me here, or if you're watching my videos, thank you for that. You're seeing some ads, and that's great. Any of you who've been making donations to my PayPal link, I do appreciate that. That is on my homepage as well. That helps keep me on the air as well. Spend time with me at Traveling with Bruce on the other side, the other channel. I talk about the markets there a little bit, but I usually talk about traveling, cruise ship traveling and that type of thing. But I do mention cruise ship stocks and travel stocks over there from time to time. Anyway, that's it for today's live show. Thank you for being here and spending some time with me. I appreciate it. It was good of you to join me, and I hope you found it informative. We will see you next time on both channels. In the meantime, stay safe out there. Don't get sick on me, and keep on top of the markets, and make yourself a couple of bucks. All right, everybody, take care. We'll talk to you later. Bye for now.